Here's a question that starts arguments at every family dinner, every finance meetup, and every TikTok finance page. It's a debate that goes beyond simple numbers, touching on our deepest beliefs about security, wealth, and the very definition of success. It pits generations against each other and financial gurus into heated online battles. Is buying real estate the best investment you can possibly make? On one side, the argument feels tangible, almost instinctual. We've all heard the stories passed down like folklore. Your uncle bought a house in 2008 for $200,000, and now it's worth $500,000. Your grandparents paid off their mortgage decades ago and now live with almost no housing cost, a fortress of financial security. The dream is powerful, a physical asset you can see and touch, a piece of the earth that is yours. It's forced savings, a hedge against inflation, and a legacy to leave behind. But then there's the other side of the story, the side that doesn't make for a great celebratory post. It's the late-night calls from tenants, the sudden five-figure roof repair, the property taxes that never stop climbing, and the years spent illiquid, with all your capital tied up in one single, undiversified asset. What about the opportunity cost? While that house was slowly appreciating, the stock market was also moving, often with far less friction and no calls about a broken water heater. In this video, we're cutting through the noise. We will ignore the gurus and the family arguments to look at the cold, hard data. We'll break down the real costs, the true returns, and the hidden risks of real estate versus other investments, so you can decide for yourself. A YouTuber bought a duplex, lived rent-free, and retired at 30. Real estate made them rich. But then you look at the stock market. The S&P 500 has historically returned about 10% per year. You can buy index funds with one click. No tenants, no toilets, no termites. So which one actually wins? Today, no hype, just real math. By the end of this video, you will know exactly whether buying property belongs in your future or not. Let's go. Let's start with why millions of investors swear by real estate. There are 4 structural advantages that stocks simply cannot match. The first, and perhaps most powerful, advantage of real estate investing is the strategic use of leverage. In simple terms, leverage means using borrowed capital to increase the potential return of an investment. While it exists in other financial markets, the degree of leverage readily available to the average person in real estate is almost unparalleled. Let's break down how this works with a clear, practical example. Imagine you're purchasing a single-family home as an investment property, and its market value is $400,000. Unlike buying stocks, where you typically have to pay the full amount, real estate allows you to control the entire asset without fronting all the cash. Instead, you'll secure a loan. With a conventional mortgage, a lender might require a 20% down payment. On this $400,000 house, that means your initial out-of-pocket investment is $80,000. This is your equity, your skin in the game. The bank provides the remaining 80%, or $320,000. They are willing to do this because the property itself serves as strong collateral, a tangible physical asset securing their loan. You now control a $400,000 asset with just $80,000 of your own capital. Now let's see what happens to your investment if the property appreciates by a modest 5% in the first year. The value of the house increases to $420,000. This represents a $20,000 gain in market value. But that $20,000 gain is calculated against your initial investment of $80,000. This results in a 25% cash-on-cash return on your capital from appreciation alone, before accounting for any rental income or expenses. Compare this to investing the same $80,000 directly into the stock market. A 5% gain would yield a 5% return, turning your $80,000 into $84,000, a $4,000 profit. The bank won't typically lend you $320,000 to buy stocks. This is the amplifying power of leverage. However, this amplification is a double-edged sword. Just as leverage magnifies gains, it also magnifies losses. If that same property were to decrease in value by 5%, your $80,000 investment would suffer a 25% loss. and you are still obligated to repay the full $320,000 loan. This is why understanding market fundamentals, managing debt responsibly, and maintaining cash reserves is not just advisable, but absolutely critical when using leverage. Number 2, cash flow. A rental property pays you every month. If costs are $1,800 and rent is $2,300, that's $500 profit. That income shows up regardless of the market. Number 3, tax advantages. You can deduct interest, taxes, maintenance, and depreciation. Even when the property rises, your taxable income can drop, and when you sell, large portions can be tax-free. Number 4, control. If a stock drops, you cannot change the company. But with property, you can renovate and increase value. You're in control of the outcome. That's the dream. Leverage, cash flow, tax advantages, and control. It's a powerful narrative, one that has built fortunes and defined the vision of financial freedom for generations. The idea of owning a tangible asset, a piece of the earth that generates income, is deeply appealing. But here's where the conversation flips. The glossy brochures and online gurus often paint an incomplete picture, focusing solely on the upside while conveniently omitting the harsh realities that every seasoned investor knows intimately. The truth is, direct real estate investing is rarely passive, almost never liquid, and its returns are far from guaranteed. It's an active business, not a set-it-and-forget-it investment. Forget the image of mailbox money arriving without effort. The reality involves late-night calls about broken water heaters, navigating complex tenant laws, and managing unexpected, costly repairs. To make an informed decision, we have to look at what most people ignore. We need to strip away the hype and analyze the mechanics, the costs, and the risks with cold, hard numbers. First and most critically is illiquidity. A house worth $500,000 on paper cannot be partially sold. Unlike stocks or bonds, which you can sell in precise increments with a few clicks, a physical property is a single indivisible unit. If you need to access $50,000 of your equity for an emergency or another opportunity, you can't just sell the living room. Your only options are to sell the entire asset, a slow, expensive process involving agents, closing costs, and market timing, or to take on more debt through a refinance or home equity loan, which isn't guaranteed and comes with its own costs and risks. This lack of flexibility is a significant, often underestimated financial constraint. If you need cash quickly, you must sell everything. That process takes time, fees, and risk. Second, transaction costs. Buying property costs 2% to 5% up front. Selling costs another 6% to 8%. And this is where most investors quietly lose money without even realizing it. Third, ownership reality. Tenants stop paying and things break at the worst time. Even with a property manager, you still make decisions. This is not passive, it is active responsibility. Fourth, concentration risk. One property ties you to one location and one economy. If that area declines, your entire investment suffers. Stocks spread risk across thousands of companies globally. Fifth, leverage cuts both ways. A 5% drop wipes out $20,000 from your $80,000 deposit. That's a 25% loss, and the debt remains. You still owe the bank everything. Let's compare directly using the same starting point. $80,000 invested. Real estate, $400,000 property growing at 3.5%. After 30 years, it becomes about $1.1 million. Add rental income reinvested over time. Total wealth reaches about $1.3 million. Stocks, $80,000 invested in index funds. Average return around 9.5%. After 30 years, it becomes about $1.2 million, very close to real estate returns. And this is the part nobody likes to admit. The results are almost the same, but one requires zero effort. No repairs, no tenants, no stress. And stocks are fully liquid. You can sell anytime. The 2021 boom is over. Low rates and fast growth are gone. What worked in the last decade may not work in the next one. Interest rates are now around 6% to 7.5%. That reduces affordability and slows demand. Younger generations have less buying power. Demand is shifting across regions. Housing supply remains tight, but growth is slowing to around 3% to 5%. Real estate is no longer a fast wealth builder. It is now a slower, steady asset. For most people, real estate is not the best investment, and that's uncomfortable to hear. Because for decades, we were told property was the safest path. That belief is now being challenged. The best investment for most people is index funds, diversified, passive, and liquid. But for the right person, real estate can outperform. If you understand leverage and accept the work, the mistake is thinking one is always better. They are simply tools. Start with stocks, then add property if it fits your life. If you made it this far, you're already ahead. Most people never think this deeply about money. So tell me, real estate or stocks? Or both? Comment math for the full breakdown. Subscribe for clarity, not hype. Build your wealth on your terms.